Required minimum distributions are quite common for most retirees. They come about because you contributed pre-tax dollars sometime in your life into a tax advantage account, such as a traditional IRA, a pre-tax 401k, that's as opposed to a Roth 401k, a pre-tax 403b, a pre-tax TSP plan, or any of the above. When you retire and you're no longer employed, at some point in time, the United States government wants to collect taxes from that account because you never paid taxes when the money went in, you never paid taxes as it was growing, and if you die without ever taking money out ever, then the government basically never received taxes during your lifetime. So one of the things that they implemented is something called required minimum distributions. When you turn a certain age, you are required to pull money out of those accounts. And when you pull money out of those accounts, it is a taxable event and it counts as ordinary income. So required minimum distributions are something that will increase your taxable income as you get older, even if you don't need the funds or if you're pulling the funds from a different account. So required minimum distributions are a big deal and they kick in at different ages for different people. So when your RMD begins is dependent on your birthday. For the individuals that were born before July 1st, 1949, your RMD age is 70 and a half. And at the time of this recording, what that means is you should already be taking your RMDs. First RMDs and second RMDs should have already been taken. If you're born between July 1st, 1949, actually on July 1st, but before January 1st, 1952, your RMD age is 72. However, there's a special rule for your very first RMD. So let's say hypothetically that you turn 72 in October 2024. In that instance, you can take your first RMD anytime up to April 1st following the year that you turn 72. So if you turn 72 in 2024 of October, you can take your first RMD all the way up until April 1st, 2025. And so you have some time to take that first RMD. Now, the downside to that is that you must take your second RMD by December 31st of that same year. So if you don't take your first RMD in 2024, when you turn 72, and you delayed it till, let's say, March 2025, you're going to have to take that second RMD during the same calendar year. Now, the potential disadvantage of this is you're going to have two RMDs in a single year, which may increase your taxable income into a tax bracket you don't want to be in. So whether or not you take your first RMD in the calendar year that you turn 72, or if you delay it until that second year prior to April 1st, depends on your tax situation. In general, for most people, it will make sense to spread those out so you don't have a high income spike in one year and pay more ordinary income tax in a different bracket. That being said, there are exceptions to this. For example, let's say the year that you turn 72 and you have that RMD, you have large capital gains, or you were still working and you just retired. So your income in that year is higher than it will be in the following year. In that instance, it may strategically make sense to shift the RMD to have two of them in one year because that year's income is lower than the prior year. But the bottom line is when you start taking that RMD, it is the year that you turn 72. First RMD has to occur by April 1st the following year, and the second RMD has to occur in that same year. After that, it's just 1 year at a time. For individuals that were born on January 1st, 1952, but before January 1st, 1960, your RMD age is 73. So the same exact rules apply, but it's your 73rd birthday. And the same is true in terms of that April 1st opportunity for your first RMD. All the same logic applies, but it's on your 73rd birthday and not your 72nd. If you're born on or after January 1st, 1960, your RMD age is 75. And again, the same rules apply for your first RMD and second RMD. If you turned 75 in October, you can actually wait until April 1st the following year to take that first RMD if you want. Same logic applies for taxes. So this is the table that you want to look at for when you take your RMDs and how they apply. Okay, so in order to get your distribution period, the number that you need in the divisor, The most authoritative source for this is going to be the Internal Revenue Service. Now, you can very likely Google both of these tables and find accurate ones from different organizations. But if you want to go straight to the IRS publication for it, it is publication 590B, and you can use the most recent publication for that. And there are two tables that may be applicable to you. You're only going to use one of them. The first table that most people are going to use is called the Uniform Lifetime Table. So if I hit Control F and I type in uniform here, you can see I have a result here for table 3 for the Uniform Lifetime Table. That is correct. I'm going to click that hyperlink, and it has brought me to Appendix B, Uniform Lifetime Table. This is for individuals who are unmarried, so it could be a single filer, or people that are married, but where your spouse is not more than 10 years younger than you, or your spouse is not the sole beneficiary of their IRA. So if your spouse and you are within 10 years of age, you can use this table. So most people end up using this table, which are single filers and married individuals that are within 10 years of age. So this is the correct table for you to be at. To get your distribution period, all you have to do is look up your age on this table. So let's say that I am 82 years of age. My distribution period is 18.5, meaning I would take that December 31st balance and divide it by 18.5, and that is my RMD at age 82. And as you can see, this distribution period goes down as you get older, meaning the amount or percentage of your account that you have to distribute goes up. So that is the first table. This is the Uniform Lifetime Table. Many people are going to use this table to find their distribution period. Just look at your age, grab the distribution period. The second table that many people will use, I'm going to scroll up here, is Table 2. And Table 2 is quite large. I'm going to scroll all the way back up to the top of the table, and I'll explain who's supposed to use Table 2. Okay, so this is where Table 2 begins. This is called the Joint Life and Last Survivor Expectancy Table. This is for individuals who are married and their spouses are more than 10 years younger than them. So if you're 11 years older than your spouse, and your spouse must be the sole beneficiary of the IRA. So if your IRA is going to your children, you do not use this table. You use the Uniform Life Table. If your IRA is going 1/3 to your spouse and 2/3 to your children, you do not use this table. You use the Uniform Life Table. This table is for individuals where their entire IRA is going to go to their spouse because they're the sole beneficiary, and the age difference is more than 10 years. So for this particular table, what you want to find here in the first column is your age, and then running across the top is your spouse's age. So I'm going to use a hypothetical example where you are 74 years old and your spouse is 62 years old. So what we'll do is we'll scroll down here. We'll find 74. But as you can see, this only goes up to age 29 for the spouse. So this table is a little wonky in this PDF. You have to keep scrolling until you find age 62 in the columns and 74 for the row. So we'll keep going. We're still at 29 in the columns. Now this goes up to 39. So we'll keep going. We're now up at 49. So we'll keep going. And I'm just going to scroll down until we get to perfect. So as you can see here, now we have ages 70 through 79 for the spouse. Oh, I said 62. Let me scroll back up. We have ages 60 to 69 for the spouse. And we'll scroll up a little bit. Here's age 74 for you. So you're 74 years old. Your spouse is 62. You're just going to go to where these two intersect, and your distribution period is 27.0. So you would take your December 31st account balances and divide by 27.0. These two cases cover the majority of RMD calculations. There are special instances where it is done different than this, but they're far less common. We're going to cover those in an advanced RMD course, and we will also cover inherited IRA distributions and RMDs in a separate course as well. But for your basic RMD calculations, these are forced withdrawals from your account, and you're going to use the Uniform Life Table or the joint life table, depending on the ages of you and your spouse, and you're going to find your distribution period. You'll take those December 31st values and divide it by the distribution period. That is your RMD. And so that's it for RMD calculations at a high level.